Welcome back, everyone. To recap from our last lesson, there are four main types of risk: market, leverage, liquidity, and counterparty risk. In this video, we are going to take things further, look at risk a bit more from an individual trader's perspective, and then at some simple techniques using orders to help manage market risk, the most tangible risk we face as traders. Before we get started with orders, I want to touch on the most obvious and the best long-term risk management tool.
What's that then?
Well, it's you. Now, I don't want to deliver a self-empowerment sales pitch here, but I do want to get the point across that in trading, this is down to you, the trader, to take responsibility to understand and manage your own risk.
That's a bit of an obvious statement.
You would be surprised at the excuses I've heard for losing trades. It's the market's fault. It's the broker's fault. It's the Fed chairman's fault. No, trading is down to you and you alone. Good traders understand this. They don't rely on others.
So do you have any practical suggestions for traders at our stage of development?
Yes, make sure you educate yourself properly. I'd like that to be with us, but if it's not, make sure you keep on learning in some capacity. The fact that you are starting to become aware of the four main risks, along with the rest of the topics covered in this introductory course, already sets you apart from other traders that are just starting out.
Well, that's good to know. It gives me confidence knowing we're well placed.
You are, but you have some way to go. I'm mystified when new traders start out without any education and expect positive results immediately. You don't expect to drive without first taking lessons, nor win a race without training hard. Trading is no different.
It's a good point. Perhaps it's naivety or the assumption it's easy?
Perhaps. That leads me on to my next point. You need to accept the risks are significant. Next, make sure you genuinely understand there is a good reason why FCA-regulated brokers are made to display the phrase "losses can exceed deposits" when marketing margin trading services. It's so that traders appreciate the risks involved and understand they may lose more than the amount they deposit.
Okay, that's noted. How do we protect ourselves against this happening?
Start out slowly. Use a practice account until you are ready to trade. When you do trade, trade with a plan. All good traders make sure that they don't place a trade until they're happy that it meets their trading plan. Your plan needs to fit with your strategy, your style, and it needs to protect you against your weaknesses. We've jumped forward a little bit here into one of our more advanced courses. We will look at the trading plans, strategies, and personal profiling in more detail there. Now, we are going to look at the most popular risk management tool. Orders are one of the best ways to manage your market risk. We've already introduced limit, stop, and contingent orders in the previous module. Now I'm going to show you how this works in practice and introduce you to another risk. By the end of this video, you will have a basic method for setting the prices of closing stop-loss orders.
Can you remind us how orders work again?
Certainly. Let's take a look at this gold chart. So we are here and I have a long position open of £1 per point, which for gold is every 0.1 move in price. and I set my stop order below the current price, and I set my limit order above the current price. Do you recall, if the price moves against me and it hits my stop order price, it is triggered and places a sell trade. If the price moves in my favor and it hits the limit order price, it is triggered and it also places a sell trade.
Yes, I remember that.
The key consideration from a risk management perspective is where to set the order levels. If the orders are set too close, then random noise might influence whether they are executed and they become ineffective. If they are set too far away, then it might lead to traders assuming too heavy a loss for a single trade, and they also become ineffective. When traders use orders to manage risk, they set them at the points that fit their trading plan and in line with their analysis of the market.
Oh, I see. It's starting to make sense now.
Good. So stop orders can help traders protect against losses beyond a particular price. Limit orders can help traders secure profits. I'm still long and I set my limit order above the current price. If the price of gold rises and triggers my limit order, it closes a profitable trade.
Yes, I see.
Had I not had my limit order in place, and if I'm not actively monitoring the price, it might go where I want to exit and fall back, meaning I've missed an opportunity.
I see. So limit orders can help secure the upside and stop orders protect against the downside.
Correct, Ryan. I want to make a couple of practical points before moving on. Brokers let you set closing, stop, and limit orders when initiating a trade. Make sure you do this in line with your trading plan. Traders should, at the very best, avoid having open positions with no stop order in place.
Thanks, Philip. And the second point?
Once a stop order has been set in line with your plan, don't ever move it against your position and increase the downside risk. No matter how certain you are, a trade will turn around. Does that make sense?
Yes, I follow. There would be little point in having a trade plan if I did.
Great. Next, we need to address an important feature of markets called gapping. An order is simply an instruction to your broker to place a trade.
Yes, you mentioned that before. That's understood. With orders, you tell the broker whether it's a buy or sell order, the trade size and price where you want it triggered.
The point here is you won't always get the price you specify in the order. A standard order, which is free to place, is only an instruction for a broker to execute a trade. It isn't a cast iron guarantee that you will get that particular price when it's triggered. It's important to understand standard orders don't come with any guarantees.
Okay, I'm not sure I understand.
With a standard order in an open market, a broker will execute immediately and give you the price at that point. However, market prices do not move in set amounts, especially in fast-moving markets. The market price might have gone through the order price.
Can you give me an example?
I will use my last gold example. On my long position, if I set a stop order to sell at 12.38, if the market price was falling and went in an instance from 12.38.1 to 12.37.8, then the order to sell would be triggered because it passed through 12.38. However, the market price is not at 12.38 and never was. It was at 12.37.8. In this scenario, it is likely that I would get filled at 12.37.8, 2 points worse than where I planned my order. Another point to note, and this is where the most gapping risks exist, is if a market is closed The broker can't execute trades and therefore cannot execute orders. The market might reopen at a different price, sometimes significantly different to the one it closed on. If the market price has moved through your order price, it can trigger a trade at significantly different price to the one intended.
Why on earth would that happen?
For lots of reasons. Some markets close overnight, and sometimes over the weekend a lot can change over these periods, which can affect the price when it reopens. This is called gapping risk.
I see.
Okay, so what can we do to manage gapping risk then?
Traders can use guaranteed stop-loss orders. These will ensure no matter how far the market gaps through the order price, the price specified in the order is the price the trader gets. Effectively, this moves the gapping risk from the trader to the broker. However, guaranteed stop-loss costs and the brokers will charge for them. In the longer term, the best way to manage gapping risk is to accept it as a trading risk and configure your trading plan accordingly. If it is a risk you don't want, you end up trading at times when you're confident gapping risk is low.
So this is for stop orders. Can our limit orders be guaranteed?
No, gapping risk works both ways. On limit orders, if the market gaps and triggers a trade, it would be in your favor. If you are filled at a better price, you will make more money. You don't want to be paying a charge to get a worse price.
Ah, yes. Okay, got it.
Before we summarize what we've learned in this lesson, I promised a simple risk management rule to help you work out where to set stop-loss orders. When it comes to setting stop orders, a basic rule of thumb is to only risk 1% of capital on each trade. For example, if a trader has £10,000 of total capital, then 1% is £100. If they trade £1 a point, that equals to a 100 point move. To risk £100 at £1 per point, the stop order should be set at 100 points away.
But if we don't want to set the stop too close, like you said it might be influenced by random noise, doesn't that limit how much you can trade?
Yes, that's the point. Remember, you're not going to be right the whole time.
Yes, I know. It's a good rule.
Good. Let's summarize things.
So in this lesson, we started to think about traders as risk managers and got some instruction as to how we might approach this.
The best long-term way to approach risk management is to take responsibility, educate yourself, and gain experience. It takes time, but it pays dividends in the long run.
This is important because the risks of trading, if not understood, can be significant. Good traders always trade with a plan.
When it comes to risk management tools, orders are one of the best ways to manage market risk. Traders set orders at points that fit their trading plan. If they're set too close or too far away, they might become ineffective.
A standard order is an instruction to a broker to execute a trade. However, it isn't a guarantee that you'll get that particular price. Gapping can happen when markets open or are fast moving. Traders can use guaranteed stop-loss order to manage gapping, but they cost.
We finished with a basic rule of thumb when setting stops. Once your stake has been decided, is to only risk 1% of capital on each trade.
Thanks everyone for your time taken to learn some of the basics of risk management. We are going to wrap up the module in the next video.